Hey guys, it's Brian with Retired at 40, and I had a pretty good reaction to my last mortgage video, so I decided to make another one because I realized I missed pretty much the biggest segment of the market, and that would be people that are refinancing, buying their first home, or trying to move up in home during these low interest rates. So we're going to talk about that today. We're going to run a real world scenario using conventional mortgage versus an FHA mortgage. We're going to talk about VA loans with our vets and talk about the awesome benefits that those have. And for your first time home buyers, I'm going to talk about which mortgage is right for you and 5 things you can do to boost your credit score before that happens. We're going to do all that and a little more coming up. Our financial education in this country is, well, pathetic. They don't cover it in schools, they don't cover it in college unless you take that kind of course, and most adults don't proactively educate themselves on it unless they're forced to. In this day and age with education vehicles like YouTube, for instance, there's no excuse not to educate yourself on your biggest investment most likely in your life, your home. I also want to touch on something that a lot of people don't ever talk about, and since I've been involved in real estate for more than 20 years now, held multiple mortgages, flipped and rented out probably 50 to 60 properties, I can tell you that real estate is cyclical. And the easiest way to watch the cycle of real estate is to see what the inventory of homes available on the market is. And that's going to depend mainly on the national market and on your small market where you live. Right now, the current inventory is pretty low, which is why prices just keep going up and up. But money is very cheap to borrow. So between myself doing 50 to 60 refis, mortgages, holding properties, refining properties, investing in properties, and flipping properties, and my wife, who also retired as a real estate broker at the age of 40, helping more than 500 people buy and sell homes and doing over $150 million in transactions, we have a pretty good grasp on mortgages. If you plan on living in your house for 7+ years, it makes a whole lot of sense to buy your first home if you've never purchased a home before, to move up in home if you've had your eye on a home or a certain type of home for a while, or to refi your current mortgage. So I just got done telling you that stuff is expensive right now. Why would I encourage you to go buy a home? Mainly because real estate, like I said, is cyclical and it's always going to come back around, just like pretty much any investment will. Prices are high right now. Money is super cheap. In fact, it's less than the inflation rate. That's why if you plan to stay in your home for a while, it makes a whole lot of sense to borrow that cheap money. And when that real estate cycle swings around again, it usually swings pretty hard. Prices will go up, and putting time into the real estate market will always beat trying to time the market on its low. And if you're trying to move up in house, it's going to be probably the easiest time to sell your house because inventory is low. And with a fresh new mortgage at a low interest rate, you can probably get quite a bit more house for about the same payment as you're paying right now. So do yourself a favor, stick around with me for a couple minutes and educate yourself on your biggest investment, your mortgage. Interest rates are so low right now that I don't think you're ever going to see them this low ever again. You need to strongly consider refinancing, and if you're getting ready to purchase a home, now is probably the best time that it ever has been. So let's run a real world scenario with the average home price of America, which is about $350,000. To give you an idea of how good rates actually are right now, when we bought our first place, we had about a 4.25% or 4.5% interest rate, and we thought that was the greatest thing ever. And that was with a 5-year ARM, which made it quite a bit lower. Interest rates today for a 30-year fixed are 2.875, and a 15-year fixed loan is 2.375. Those are both conventional type loans. If you pay for points, you can actually buy down the rate really close to 2%. FHA and VA are 2.25 right now. We're going to run our example for a conventional loan, but we're also going to touch real quick on FHA loans, which pertain more to first-time buyers and people with a higher debt to income, maybe less credit. Then I'm going to give you 5 tips to improve your credit score. So our example is going to be a $350,000 house. That's the average home price in America. We're going to compare the difference between a 4.5% rate and a 2.875, which could potentially be even lower than that with a VA or an FHA, or if you buy down the points. Your payment on a $350,000 loan at a 4.5% rate is going to be $1,773 a month. You're also going to need to add in your taxes, insurance, and HOA. But if you compare that to a 2.875 rate, or it could be potentially lower than that, your payment's going to be about $14.52. And keep in mind, this is just principal and interest. This is not including taxes, insurance, and HOA. There's lots of variables when it comes to that. If you had a VA or an FHA loan at 2.25, the VA would be $13.87 and an FHA would be $15.54. You're probably wondering why the FHA payment is actually higher than the conventional at 2.875. We're going to touch on that in a little bit. So let's assume that our closing costs are roughly $5,000, and then we take our savings of around $300 per month. That means our break even on $5,000 only takes about a year and a half to make up. You also might want to consider having a conversation with your lender about adjusting your interest rate to cover your closing costs. So you can take that $300 and something every month and you can put it in your pocket, or you could spend it on something else, or better yet, you could put it back into your mortgage, which would pay your mortgage off 8 years faster and save you $46,000 in interest over the course of the loan. So before we wrap this up, let's talk about the benefits of FHA loans and VA loans. The qualifications for FHA are a little bit more loose than a conventional loan. FHA loans are going to give you a lower rate. You can't come up with as much money for a down payment. The down payments are a lot less. The debt to income ratios can be a little bit higher, and your credit score can be quite a bit lower than conventional. The one big negative of FHA loans is that you're going to have private mortgage insurance for the life of the loan, unless you refi it out of an FHA type loan. And depending on your credit score, that amount could be $200 to $400 per month. And then let's not forget our vets, because they can apply for a VA type loan that has lots of benefits. So America loves its vets, and for the most part we treat our vets very well. The VA loan is no exception to that. So a VA loan requires no down payment, there's no private mortgage insurance, no prepayment penalties. It also puts a cap on the amount of closing costs that lenders can charge. And let's not forget that that interest rate is 2.25% right now. And probably the greatest thing about the VA loan is that once you're a vet, you can use that VA loan for your entire life. And really the only downside to the VA loan is there is a VA funding fee, and that just takes a certain percentage of the loan and rolls it into the loan. So if you're considering the VA loan, that's definitely something you should check into. Now let's talk about first-time home buyers and people that have had some credit problems. If you're considering buying your first home and you need a little credit boost, or you already have a home, or you have had a home in the past and you just need a little boost in credit, here are 5 tips to raise your credit score. Make sure you're paying your bills on time. When someone who's getting ready to loan you money sees that you've had late payments, that's going to have a big effect on your credit score and their willingness to lend you money. Pay attention to your credit utilization ratio. This deals with the amount of credit that you have available to you versus the amount of credit that you've used, and this is especially important when it comes to credit cards. Did someone say credit cards? Apply for them sparingly, and apply for any kind of credit sparingly, especially if you're getting ready to purchase a home. Or better yet, don't do it at all. Number 4, monitor your credit. Most people don't know that you can dispute things that are on your credit report that you don't necessarily agree with. And even though it seems opposite of what it should be, don't always close down your credit cards that you don't use anymore. Pay off the balance, leave them open, because time open in an account actually helps you out. I would also strongly recommend finding a good lender, because most lenders can help you actually boost your credit score. It's in their best interest to get you a better score so they can do their job and actually lend you some money. Well, that's it for today, guys. I hope you found this helpful. If you're a first-time home buyer, if you're questioning whether you should refinance, or if you just need a little bit of a boost with your credit. If you found it helpful, do me a big favor. Just hit that like button. It really helps with the YouTube algorithm, helps this video get out to the people that it should be getting out to. As always, if you ever have any questions, shoot me a comment in the comments section. This is Retired at 40, reminding you to live life simple. We'll catch you next time.